As a private lender, your most important job is to fund safe, profitable loans and not lose capital. Let me repeat that. Do not lose capital. This has been our top focus for the past 19 years running Hard Money Bankers. I know so many private and hard money lenders, although they have good intentions, they make undisciplined decisions that have led them to financial losses. They only worry about lending based on the after repair value, and they're not worried about their day one number, their day one exposure, and they're not focusing enough on the quality of the borrower. Next thing you know, the borrower can't execute properly, the house is underwater, and eventually they walk away from an incomplete project, and it leaves you as the lender having to fix the mess. Let me share my screen real quick. I put a few slides here together for you to discuss exactly ways that you can protect your capital. All right, let's use this one right here. You can still see me, and we can go through some of this stuff. So let's talk about loan loss reserves. Do you actually need loan loss reserves? Now, if you're an institution, if you're a bank, if you're a large fund and you're doing very aggressive deals, then you probably do need a loan loss reserve. If you're giving high leverage, 90, 100% financing, you're probably going to need loan loss reserves, just like banks do, and just like institutional capital sources do, because they're taking losses. And when they take losses, they lose principal. We typically, at our company and most other lenders that I know, don't usually put themselves in a position where they could jeopardize principal. And that's because they're requiring the borrowers to bring high down payments. They're lending with quality borrowers. They're making sure they're at a good LTV so they don't have to do that. Typically, if the borrower brings a lot of money to the table and there's a lot of equity in that property, you have that underlying collateral to rely on if the deal goes super sideways. Think about this to yourself. This is an important question. There's two questions to ask yourself. If you do a loan to a borrower and they get hit by a bus, God forbid, tomorrow, can you recoup all of your money? Can you recoup all of your principal? And if you're giving 100% financing on day one, and what I mean by day one is if somebody's buying a property with, let's say they buy it for $100,000 and it's worth $100,000, it needs 30 grand in work, and it's going to be worth 200,000, right? So you take 100, you add 30 to it. That's a 130 total loan. Let's say you do a $30,000 construction holdback. Your day one exposure is 100 still. You have a 65% LTV based off of the after repair value, but your day one exposure is still 100%. You're giving them 100 on a $100,000 purchase. They get hit by a bus, you're going to lose money. Okay. So that's the first question to ask. The second question to ask is, at the end of the day, throughout the loan, let's say the borrower only does half the work or 3/4 of the work or all of the work. Are you going to be safe if you have to go foreclose on that property? Because foreclosing on properties, it's not like, oh, give me the house back and I'll take it over. It doesn't typically work like that. Even if you can get them to sign a deed in lieu of foreclosure, by the time they get to that point, they're probably already past due. They're in default, other tax and insurance. There might be other attorney fees that accrue. So the answer is you might need loan loss reserves, but if you're lending at a very conservative number to the right borrowers, it's probably going to be a smaller amount. Let's talk a little bit about as-is value. This is like the most overlooked thing in lending. Like I kind of just talked about, most lenders only base things off the after repair value. I ask them what they lend, right? Like if I ask a lender, hey, what are your terms? Like how much do you lend? Oh, I lend 65%. And I'm like, cool, 65% of what? Oh, 65% of the ARV. And it's like, okay, well, what about the as-is value? What do you lend off that? Well, I mean, it doesn't really matter. I just do it based on, the after repair value, right? So like we already did the math on this last one, and this bullet point's going to overlap a little bit, but I really want you to get this into your head, because this is like the most important thing, and this is why lenders lose all the freaking time. It drives me nuts. You shouldn't be losing principal. The first lender should have the least amount of risk on any real estate transaction. You should be the safest person in a real estate transaction if it's structured correctly, right? The borrower, the equity partners, should have the most, right? Because if you're only lending at a low LTV, you're first right. Like you should not be losing principal in this particular case. So again, same example as I used before. They bought the property for $100,000. It needs $30,000 in work, and it's going to be worth $200,000. So they'll say, oh yeah, lend up to 65%. Great. So you're lending 65% of $200,000, which is $130,000 total loan. And then you're holding that back to construction costs. No problem. That's the right way to do it. And you're reimbursing as the work's getting completed. But again, your day one exposure is $100,000. You're lending 100% of the purchase price. That's not good. Do not lend 100% of the purchase price. You got to understand what the as-is value is just as much as the ARV value. So you'll say, hey, Jason, great, I get it. I know I know I'm taking a lot of risk on the front end. What do I do? Like, do I make my borrowers bring 35% into every single deal? And the answer is, in a perfect world, yes, but you got to work something that's going to make sense, right? So again, I'm overlap on this bullet point as well as we're talking about these. These are flowing together. But the point is you got to have them have some down payment for number one, skin in the game. Number two, to reduce your day one exposure. So let's say you have like a 20% down payment, right? Typically, we're minimum 20%. A lot of the time, we are closer to 35%, give or take. It also depends on where the market is and how well they buy the property under how well they purchase the property and things like that. But let's do the math now at 20% down payment, right? Same numbers, right? They're buying it for 100,000, needs 30 grand in work. If you make them put 20% down, now you're giving them 80,000 up front plus that 30. So your total loan is 110,000 with a $30,000 holdback, right? So instead of 130, you're at 110. You have $20,000 more of cushion, and you have it at the right time. Real estate investor or hard money lenders don't typically have an after repair value problem. They have an as is value problem. Because let's be honest, in this deal, you have a 35% equity cushion, right? You're doing a 65% ARV, but you only have that equity cushion when the property is done. If you give somebody a $130,000 loan, they execute perfectly, and they have it on the market for $199, and like that's what it's worth, and that'll sell quickly, you're good. You have $70,000 in equity, $35,000 in equity cushion. You're in a very safe investment. The problem is you're not safe day one. And day one is where all the risk is, or a lot of the risk, right? Things happen. They don't get permits that they wanted. They get hit by a bus. God forbid, something worse happens to them. They decide like, hey, this is a crappy deal. I'm not gonna. I decided my numbers don't work. I'm not gonna move forward with it. They flip multiple properties at a time, and they get held up on another one, and then they forget to do this one. These are all things that have happened to us as a lender. So I'm talking from experience. I'm not just like, this isn't hypothetical. All of these things happen. They've all happened. So that's the thing. But now let's look at this one. If you make them put 20% down off the purchase price, they put an extra, and keep in mind, this case, they have zero money in the deal. Maybe they got $10,000, $15,000 in closing costs. What do you do? Cash into this thing, cash to close, like that's it. In this particular thing, they're going to, two things. Number one, they're going to have more skin in the deal, $35K cash to close, minimum. Just for the record, we would not do in this case, we would not do 20% down. It's not enough cash to close on the deal. It's just not. Typically, our minimum cash to close is probably like 50 to 60 grand, no matter what. Anyways, I want to make sure they have ample cash and skin in the deal. That is so important. So in this particular case, they actually have real cash in the deal, and you have a 20% equity position, 80% LTV, but 20% in equity additional in this case. So let's say the borrower completely disappears in this particular case. Well, what happens? You go file foreclosure. They're back on payments. Maybe if you're in a state that takes a long time, maybe you got to step in and pay insurance costs, taxes, things like that. But at least you have a $20,000 buffer in this case. And I think that's important to have all that in place. Ideally, it'd be more. All right, let me erase some of this stuff and we'll keep it moving. If you have any questions so far, comment below in the video and I'm happy to discuss them. I think this is a very important topic. And it's just, I'm telling you, this is what's overlooked. I mean, we've worked with hundreds of people in the mastermind group. There's thousands in the group, but we've worked with, at least over 100 of them. And a lot of people have this exact same problem. So don't feel bad if you already have this problem. The point is fix it. If you're doing 100% financing, go down to 90, then go down to 80, then go down to 70. And it takes time. You're going to lose good borrowers, and I get that, but it is important because you cannot lose capital. That is yeah, so important. So let's talk about, a light default case study. And this is a real life example. Then we're going to talk about kind of a more detailed one, or a more nightmare version. But let's just talk about a light default that we wrote a loan the right way, and it works out because you do the right loan. So we did a loan for a borrower. The borrower bought the property for 320 grand. I'm gonna write that here. And it needed 45,000 in work. Okay. And we valued it at 425. Those numbers aren't great. They're just not. There's not a lot of profit. So obviously the borrower thought it was worth more than that. We ended up doing a loan of 260 with a $45,000 holdback. And the way that was set up is that was 215 towards the purchase. So if you take 260 minus 45, that's 215. So that means we did 215 on a 320 purchase. I don't fully know exactly what the actual as is value is, but let's just say it was the purchase price or close to that purchase price. So if you take 215 and you divide it by 320, that's a 67% day one number, right? 67%. That's a good, fair, safe number to be on the front end. So in this case, 260, 320 they bought it for, $45,000 they had to put into it. So that's 365 plus closing costs. We're kind of in a state that has expensive transfer recordation tax. So let's just say whatever, 25 grand. So that's what, 385, call it. 385 minus 260. So they needed $125,000 cash to close, right? Which is good. 125K cash to close on a deal. This loan just paid off, by the way. So we wrote it, a little bit less than a year ago. It just paid off. So it was 125,000 cash to close on a 260 loan amount, right? Not bad. Like, that's a lot of cash to close based on this number. Like, that's important. Okay. So this is what went wrong. Construction went over budget. It was a $45,000 construction budget. Like, it probably cost them significantly more than that. We underwrote the scope of work up front and knew it was could be on the tight side, but whatever. So that probably went over budget, right? And then it got to a point where a lot of these borrowers, if you're charging 12%, 13%, 14%, like, that's a lot of money. These things aren't cash flowing, right? Because they're fix and flip loans. So that means they're taking money out of their pocket to pay the monthly payments. Well, at some point, it just becomes beyond a burden and it becomes expensive to continue to bankroll and fund these. So we had a conversation with the borrower towards the end of the year. We did some extensions and things like that. And it got to a point where it's like, hey, listen, like, I'm tight. I don't think I can make my monthly payment. And we're like, well, can you finish the project? And they're like, yeah, if I don't have to make the monthly payment, I can finish the project. And we're like, cool. That is a fair arrangement. Get the project finished. They said it was only going to take 30 days. Get this sold. And we, missed the next payment or two, right? Well, it got to the third payment and it wasn't sold yet. And we got a little, we were like, what do we do in this case? Because one or two payments isn't a big deal. They communicated, right? We're almost at the third month, called them. And I was like, hey, listen, like, I got to get a payment in from you guys. Like, you're 3 months late. I understand you had challenges. And they're like, Jason, I can make one payment, but that's it. And we're like, no problem. So they made a payment. They ended up selling the property a few weeks later. And we collected, the regular 3 months at the back end. It was a good win-win situation for both parties. We didn't have to default them. We didn't have to put them into default interest or anything like that. They communicated. They were honest. They were able to make some money payments as needed, and it worked out. So we're happy with that. And that's probably a real life example of what will happen to you. And maybe you can charge some fees if you want on that. But that's kind of a good outcome for both sides, because you don't want to, defaulting loans and going hard at them isn't always the answer. Like, it makes it's turns into challenging. You want these loans to perform and then eventually pay off. All right, so let's talk about one that was a little bit rougher. So, and this one's technically still going on. And real quick, the reason that this one worked is because they brought so much cash to the table. They're not going to walk away from that in this particular case. Okay. Here's another one. 334 purchase price. We thought it was going to be about a 690 ARV. I actually think their purchase price was really good at the time. Well, I still think it was good. They, what the heck was it? Oh yeah, the rehab was about 50 G's on that particular case, and we did a loan of 320 minus 50, so 270. It's 270. Get my calculator out. 270 divided by 334 is 80 LTV. Okay, 20% down. Well, that was not enough down payment in this particular case. So we did a loan of 320. They brought 90,000 cash to close, give or take. So 90K. 90K is a good amount of money, but it was also a 320 loan amount. So we were too aggressive on this deal. And part of it was they were bringing 20% down, but they also got a good deal on this thing. So that was one of our reasons. But looking back, like, we lent way too high than we should have, because I was a little bit nervous on the borrower's execution. And surely enough, they didn't execute on this thing. And 2 years later, they still have not executed on this thing. And they've been making bad decisions along the way. So we have a little bit of the construction money still. I think they ended up kind of patching the project together last minute and trying to sell it, not getting the number that they wanted. We had to file foreclosure because they stopped making payments. They filed a Chapter 13. Now, keep in mind, when borrowers file Chapter 13s, like 9 out of 10 times, or bankruptcy, I should say, in general, 9 out of 10 times, they're not bankrupt. They're just using that as a stall tactic, in order to just not get foreclosed on. I get it. Okay. So we were able to petition the court, get the bankruptcy removed, go back to foreclosure sale, file bankruptcy again, right? They're following the process. So we still couldn't foreclose on it. Through this process, we actually knew another real estate investor that would buy the property at, like, in the 5-something range, which was fine. It was enough to pay everybody off. They didn't accept that, right? So they're getting chased around. Now, here's the deal. Our loan is 320, right? We had a $50,000 holdback. We are in a good position after repair value. And because of that, like, they don't want to walk away from their 90 grand that they put into this thing. And they also have a good bit of equity. So, like, as is value, we were pretty decent. And after repair value, we were pretty decent. And if they would have walked away from this thing completely, if they didn't have any skin in the deal. But the problem is, and in that case, it might not have been the worst thing in the world, because they did get it at a very good under market price. But the problem is, when you're dealing with an unsophisticated borrower and they're making life difficult, like, they're just eating up attorney's fees, legal fees, taxes, insurance, equity. Like, it makes it challenging. That being said, we're in a good equity position. So we're going to get out, hoping we're going to get some interest, but at the very least, like, we're still going to protect our principal balance. Our principal balance is higher than this at this point because we have attorney fees that get taxed on to principal. I don't know if we came in and stepped in and paid tax and insurance. We usually do in defaults, but I'm not sure in this particular case. So point being is like, when a loan defaults, it freaking defaults. Like, it's not like a little default. Like, they default. It takes time to do all this stuff. And the important part of when you're working defaulted loans, like, you have to make a business decision. You can't just stick to what is on the note or the deed of trust and the mortgage. Be like, yep, you're 1 day over, I'm going to charge you a late fee. Or you're 1 month back, I'm going to up my rate to 18 or 24% or whatever your default interest is that you can charge in your state. Right? Like, you have to make a business decision of what makes sense, what does not make sense. There's a lot of loans that we have in our books that are technically in default that we have not defaulted because we've been communicating with the borrowers. They're in a good spot. Like, we're comfortable with that particular case. So we have not defaulted them, and we're working to just get the loans to be paid off. And it's important to be able to communicate with these real estate investors and these borrowers to do so. Again, I know lenders that just go by the book. Nope, my note tells me this, I can do that. And I think that's very short-sighted, and we've been short-sighted on that. I'll tell you a story. Maybe year 2, into our careers, we were doing a lot of loans for this one or two groups, and they did some really good projects. And I remember they were 6-month loans back then. And one of the loans, we probably did a dozen deals for them over like a year and a half before that. And they always performed. We had one of their deals that really went over the time frame, and it was over 6 months. And we went to them and said, "Hey, listen, you're in default. Like, you got to pay us these extension fees. We have to up your interest rate." And they were so pissed, and they were never did a deal with us again. And I was thinking about it, like I was like, "Yeah, well, that's what the note says. Like, if I take a loan out from Wells Fargo or from any lender, a car lender, and I'm in default on the note, I got to follow what the note says." But in that case, we made a poor business decision, and we should have just worked with them on this. Hey, just keep making regular payments, maybe pay an extra point as an extension fee instead, and we would have kept that relationship. So luckily, I learned that learning lessons early on. But like the old saying that I do believe is true is like, in this business, pigs get fat, hogs get slaughtered. Private lending offers plenty of opportunities to be a hog, so don't fall for it, right? Like the may do what's a good win-win for both parties. And I think that helps. And in general, you got to work through your defaults, and on your exit strategies, make something that's realistic. Like, if you have a loan that does not have a lot of equity in it because you screwed up on the front end, you can't give it to, I'll give you a good example. You can't give it to a powerhouse law firm that's going to charge you $20,000 in legal. It doesn't work like that. We have different law firms that do defaults for us depending on the situation and the areas, right? And there's deals that like we're nervous about because there's not a ton of, a ton of equity in it. And hey, what makes the most sense? Should we go through the whole foreclosure process? Should we try to do a deed in lieu of foreclosure? Should we try to do a modification and make the loan more affordable for the borrower? Whatever the case is, should we allow them not to make payments for a certain period of time? You got to make a business decision and help with a realistic exit strategy. And if you're not pulling credit up front, shame on you. You need to pull credit up front, right? A lot of exit strategies these days as borrowers want to hold as rental properties. If they have bad credit, they can't refinance. Get a credit report up front. All of this stuff falls on doing the right loan for the right borrower up front, right? Making sure they have that they know what they're doing, making sure they have down payments, making sure you're underwriting the collateral and the as-is value and the after repair value, making sure they're skin in the deal, they can execute, making sure they have a realistic exit strategy to begin with. That's so important. Yeah, so that's where we're at on this private lending playbook. Um, Real quick, if you want to follow step by step, first underwrite the as is value, not just the after repair value. It's so important. Your day one numbers protect you when the borrower fails to execute. Make sure the borrower's got plenty of equity in these deals, 20% minimum. That cash keeps them into the deal, and it makes it hard for them to walk away. Any questions related to this topic or this video or any other videos that I've done, feel free to comment below this video. I like to check them, and best of luck in your private lending success.